Hello, welcome. I'm Mike from Canavan Wealth doing my monthly webinar. This one's called Risk, a Different Perspective. It's important to note that we are filming this in the middle of March 2023. Silicon Valley Bank failure is kind of front and center in the media right now. It's going to play into this here in a minute. So let's jump into this. I want to talk about I think, a valuable way for people to start looking at, kind of the last 10 to 15 years and how they view risk of stocks and bonds in their investments. So let's start by looking at the S&P 500 over, kind of going back to World War II. It's important to remember that this scale is logarithmic. That's why this looks linear and not exponential. But if you put it on a linear scale, then all the detail gets washed out. So the whole point about talking about this is that to show that through all of history, the current situation for the financial markets has been dramatically different. And you can't look at any one 10-year period and compare it, one for one to another period because of how different it is, right? Post 9/11, the 2008 global financial crisis, World War II, the Cold War, these are all things that dramatically defined their time periods, which is a great lead into the situation we're in right now, right? Land war in Europe, I don't think too many people saw that coming, a global pandemic that disrupted supply chains and changed the way the world worked and employment in a dramatic way. And then, of course, here in the US, the incredible rate at which we have been raising the federal funds rate is really unprecedented. And that creates an economic time period right now that is going to be unlike any other, right? So kind of moving on. So looking at the stock market, I just tried to convince you that we cannot, compare any 10-year period to another 10-year period because they're all very unique. And yet there is one general trend that the stock market, kind of always continues, at least in the past, to go up. Mark Twain is always famously quoted as saying, history doesn't repeat itself, but it often rhymes. So we can't ignore that trend, despite the fact that every period is different. But let's look at the periods where the stock market did not go up. So this little chart here shows you the longest stretches between new highs on the S&P 500. This was crazy when I, started looking at this. Now, this is the year that it ended, the date that it ended. So in 1954, it ended a 25-year stretch. This is in days. Where this S&P 500 did not hit a new high. That's effectively from the the beginning of the Great Depression to the end of World War II, after World War II. And then the next two are 7-year periods ending in 1980 and 2007. This is the dot-com crash. And then this 2013, this is actually the end, remember this is the end of the 2008 global financial crisis, 5 years. One of the worst kind of financial crises that we've gone through in modern times. And it was still over in 5 years. Now, recent history with the stock market has made us we don't have much of an appetite for a stock market that does not continually go up. One of the reasons that this current downturn feels so bad is because of how long it's been, right? We really have not been through a recession this long, even though we did have one back in 2016. It was 417 days. This is an episode a couple of months ago. I have to get this all through compliance, so I can't really change this. We're really up here in the 400s. My guess is we are going to be up here by the time we are hitting a new high on the S&P 500 in the 6, possibly 700-day category. That's all speculation on my point, though. What I'm saying is that the real point here is, although in the last 10 years, the market has seemed to just do nothing but go up, will we possibly go through another period where we go through 5, maybe 7 years where the stock market does not go up? I would be shocked if we didn't, right? I don't know whether that would be next year, we are currently in it, or whether that's 30 years from now. But I would be shocked if we did not go through a period in the future where the S&P 500 does not go up for 5 to 7 years, or doesn't hit a new high. It's not that it doesn't go up, but it doesn't hit a new high. All right, we're going to come back to this. So let's talk about this kind of conventional thinking about risk. This is, if you Google risk and how aggressive should you be, this is what it's going to come up with. Older people should be more conservative, younger people more aggressive, and that there's this magic formula of 60% stocks to 40% bonds that maximizes growth during growth periods, but minimizes the downturn. This has been famously enshrined in investing kind of mantra for years and years. It was on the Series 7 when I took it, which is the licensing exam for a financial professional. But over the last 10 to 14 years, we're going to see why that has not performed very well. So what happens to this philosophy when, a traditional thinking about risk, when the federal funds rate has been so historically low? So this right here is the 2008 global financial crisis, when interest rates hit historically virtually zero. They stayed that way for many years, rose a little bit. Then we saw COVID again. They went right back down to zero. And then we have seen this incredible rate hike over the last year and a half now. At the time of recording, we're actually up here in the 4.5, may go as high as 5 or 6. What happens here is that bonds become very unattractive. First reason is because when the interest rates are this low, they just don't return that much, right? When the Fed funds rate is zero, you're looking at corporate investment grade bonds that return between 3 and 3.5%. It's not great. When you pair that with reason number 2, which is interest rates are zero, the most likely place that they are going to do is go up. We really don't have an appetite for negative interest rates here in the US, but interest rates go up, then old bonds become less valuable, their face value drops, and when it starts at zero, it is a very dramatic drop. For example, looking at the Barclays Ag, the Barclays Ag is kind of a bond index here in the US. It's very complicated exactly how it works, but you can think of this as kind of a general overview of face value of bonds. You can see in the global financial crisis here, bonds dropped dramatically, came back certainly faster than the stock market. Saw a similar drop during the COVID downturn, not quite as bad. And then, of course, famously, the most recent drop here due to interest rates going up. If you look at the Barclays Ag over the last 10 years, it has returned less than 1%. Hasn't even kept up with the historically low inflation that we saw over the vast majority of those 10 years. Now, a lot of that damage was done in the last year, but even if you start here, even from here to here, this is not a lot. It's not great return on bonds. And you got to remember that this does not show interest rates included. However, interest rates were extremely low. So even with interest rates in, this is not a great return on investment. So what did this do to the 60-40 portfolio? It made it underperform. Because if we look back over the last 10 years, the optimal strategy is easy to figure out for the last 10 years. You should have invested in US large stocks, largely in the tech industry. But is that likely to be the optimal way to invest for the next 10 years? There's no way to know that. And certainly the story around bonds is changing. So like right now, I think we are in a transition period for modern investing that we don't know what we are transitioning to. Because interest rates, although they have been historically low, and the Fed's stated rate, target is to get them below 2% again, we don't know where they're going to fall out, which means the whole story around bonds could change again. Could the 60-40 portfolio come back and kind of regain its place in investing philosophy? It could. However, lots have changed since we lived in that low interest rate world. Index-based ETFs have become so prevalent, and there's so many other things. Access to good investments is good. Kind of consumer sentiment is totally different than it was before we lived in kind of 0% Fed funds rate. So there's going to be, I can't imagine that we're just going to look like, the early 2000s, late 90s. All right. So, as I talk about the 60-40, it's not that it has fallen out of favor. It's that it is an oversimplified process to diversity, which we're going to talk about. And it just underperformed for the last 10 years. But if you follow the philosophy, don't try and chase your tail of whatever worked the last 10 years. The market is too efficient for good investing trends to last that long. All right, let's just talk about risk in general. There's short-term and long-term risk to virtually all investments that are very different, right? In the stock world, short-term risk is about rapid swings in the stock that can happen day to day. And the long-term risk is really talking about, is the market going to continue to trend upwards, or is 2021 literally the highest the S&P will ever look? I've some interesting thoughts on that about demographics and whatnot. I would not worry about that too much in the near term. 30, 40 years from now, that could be a concern. You might want to check out the YouTube channel for stuff on that. In terms of bonds, the short-term risk is often around current interest rates, right? Is the bond an attractive investment at all? And are those current interest rates so low that future interest rate risk becomes a problem? And of course, long-term, we're not talking about, do you know what the interest rate environment is going to be like in the future? Are rates going to be going up or are rates going to be going down? Now, when your bond starts at a decent interest rate, 5, 6, 7%, changes in interest rates are not going to have as profound an effect. If the Fed funds rate is 0 and you're buying a bond at 3%, then changes in interest rates are going to be very dramatic. And are we going to be able to keep up with inflation, right? In the recent past, bonds have struggled to keep up with inflation. All right, let's move on here. Okay, so this conventional thinking, older people should be more conservative, younger people should be riskier. Throw it out. It's garbage. It's probably done the most damage to clients and folks that I've talked to if you think like this. I'm older, I'm close to retirement, then I should just be more conservative. Or I'm young, and thus I should just be very aggressive. We've already talked about how the 60-40 kind of split is just oversimplified. So let's go back to this, talking about conventional risk and this idea that if you're older, you should just be more conservative. It's more complicated than that. There's a lot that goes into it that often correlates to your age, but I think time frame is more important than age. Meaning, how long do you expect to hold this before you may need access to that money? Similarly, your unique family situation, often when we're talking multi-generational, which we talk a lot here at Canavan Wealth, T-Town Wealth is my local business here. This becomes so important when you start planning on a generational time scale in terms of where we're going to be moving money around and where ultimately this money is going to land. And just because you're older does not necessarily mean you should be more conservative. And very similar with younger clients, I've heard way too many stories of people who have bad experiences early on in their investing career because they were being aggressive, that are then scared out of the market, and they come to me at age 50 and say, hey, look, I've been out of the market, I just had a bad experience, but retirement is looming, I just got to get my act together and what we can do. And so just because you're younger does not mean, and we're going to talk about this in appetite in just a minute, but does not mean that you should be ultra aggressive. It's more about the time frame of your investment and the purpose of it. So time frame along that thing pairs with scale, right? So this is the other part of time frame, which is, what is the scale of your investments compared to your needs, right? You could have a 65-year-old with $500,000 in investments that they are going to be living off of, taking an active draw off of, and an 85-year-old that has $1.5 million in a pension and largely is not planning on touching that. Those are two totally separate and different situations when it comes to risk. And yet by conventional thinking, the 85-year-old should be purely in bonds and the 65-year-old should be in like a 60-40 portfolio. Okay, what you really need to understand is, does the short-term risk dominate or does long-term risk dominate, right? Short-term risk dominates when you're taking a substantial draw off of your assets, and any type of short-term movement could move your portfolio into a situation where it is unlikely to recover in a downturn, right? Long-term risk dominates your portfolio if you not necessarily have a big draw, something like 3% or less. And the bigger risk to you is that whatever rainy day that's planning for, that your spending power reduces due to inflation. Inflation is the enemy of the retiree, right? It is not the market. The market is going to do what it is. Inflation is going to do what it does too. But the more damaging effect for someone who does not largely have the option of re-entering the workforce or is on a, is on a fixed income scale will be dominated, by that. So long-term versus short-term risk. Okay. The last one is appetite, right? So you got time frame and scale, and then the third one of these things, time frame, scale, or appetite, is largely going to dominate, and then the other two kind of affect it. No matter what your investment advisor tells you, it is their job to take your personal experience with investing and what you're comfortable with and to blend that with what they feel is best for your investment. Because we're supposed to make your life easier, not harder, right? And if we or they are ignoring your beliefs, then more damage can be done in terms of your willingness to be there, in the future in the markets when the good times eventually come, right? If you can't deal with the bad times, you will not be there for the good times, and then it really doesn't matter at that point. Okay. All right. So if it's time frame, scale, and appetite, then what's the conclusion here? And I know no one wants to see this answer because it's so boring. Diversified portfolio. Every advisor you've ever talked to has talked to you about a diversified portfolio, except the ones on YouTube that are trying to sell you some product. Unfortunately, it is the answer, but there are some interesting things to talk about when we talk about that. So what are the interesting aspects of diversified portfolio that have changed? Because in my opinion, this has dramatically changed over the last 10 to 14 years. We used to talk about the 60-40 portfolio, right? And the 60% of it that is stocks, we used to talk about different sectors. We want to be invested in the energy sector and pharmaceuticals and healthcare and consumer staples and these things, because there was this philosophy that, well, just because energy's down one year, maybe pharmaceuticals had a good year, the financial sector did well, and they kind of balance out. We used to have all these charts about like what sectors were doing well. In my opinion, because of how investing works now, largely through index-based funds, that we don't see that as much anymore. Now, last year we famously saw that with the energy sector performing dramatically differently than the rest of the U.S. stock market. However, when the market's up, all markets tend to be up, and when they're down, all tend to be down, is kind of the generality we're seeing more. And now I think those kind of sectors have changed to tech still does kind of stand on its own and perform differently than the rest of the world. Then U.S. growth, largely the S&P 500, when I'm talking about there, tech, I often talk NASDAQ 100. And then value stocks, right? Sometimes kind of correlates to the Dow, but they have their own indexes. So value stocks and growth stocks have started to become divergent because I think investors use them very specifically these days as an alternative to bonds, right? When interest rates are so low, what do you turn to if bonds are just as risky as stocks? Well, they've really turned to value stocks. We saw that last year when value stocks kind of outperformed the S&P 500. So what a diversified portfolio has changed. That 40%, that bond number has changed a lot. A lot of advisors, myself included, have started to turn to more heavily weighting value stocks and using it as kind of a fixed income or conservative play option. But all of this may change. I cannot stress this enough, depending on what happens with interest rates over the next 6 to 18 months, right? We're very much in this transitional period. All right. So you can't ignore the past. We talked in the beginning about how investments, the S&P 500 has trended up, but all of those time periods were different. So we can't ignore what we've seen in the past, but we also can't base our decisions entirely on, well, this looks like this time period, and thus we should do this. The next big volatility event, right, the next big 2008 or Great Depression, will be unforeseen and different than any other one. If you think that's now, which is a fairly reasonable thing to believe, that here in 2023, we are in the next big volatility event, big downturn. Land war in Europe, 2 years, pandemic, historically aggressive rate hikes. This is unlike any other time we've seen. And, only time will tell what it looks like. So we already talked about kind of short-term and long-term trends. This is the big takeaway for clients that want to be conservative. In my belief, relying solely on traditionally conservative investments like bonds can be riskier than utilizing a broad investment portfolio that has multiple different investment types. The last 10 to 14 years has been a great example of that. And I could not have timed this seminar better than what's going on with Silicon Valley Bank. largely invested in long-term treasuries, considered one of the most stable, reliable investments with incredible creditworthiness of the US government. They get in trouble with them because of no one would have guessed that rates would go up this fast, this high. They turn out to be underwater. They get a run on the bank. I did a video on SVB if you want to learn about it. I'm not going to go completely review that here. Gets them in trouble. Were there other systematic problems with that bank? Absolutely, but it is undeniably were affected by the historically aggressive Fed funds rate hikes. All right, there are some disclosures. I will put my face where you can hopefully read all of these. And if you have any questions, send them to mike@canavanwealth.com. I do these webinars monthly. They're all posted on the website as well as my YouTube channel. If you can also set an appointment off my website, canavanwealth.com. Other than that, I hope that this has been informative and you enjoyed it. I will talk to you soon. Thank you.